investment property. IS 40. Now we have finished IS 16 on property, plant, equipment. Is that right? So now let's look at page 94. Now what is investment property? Property. Why don't we classify under property, plant, equipment? So investment property, if you look at definition of investment property. Now, investment property are those property, land or building, which are held by the owner or the lessee to earn rentals or for capital appreciation or for both, rather than for use in the production or supply of goods and services or for admin purpose. If the property is used for in the production of supply of goods and services or for admin purpose, what are they for? Use, for own use in the production of your goods and services or for administrative purpose, then those properties are classified as your property, plant, equipment, isn't it? PPE. If it's held for sale in the ordinary course of business, buy and sell, then they will be your inventory, isn't it? So investment property are those properties which are not for own use, not for sale. Then it will be investment property. So in other words, what is the definition of investment property? So investment property are those properties, investment property. I just put it as are those land and building which are held for definition of investment property. Now, these properties are held for what purpose? They are held for, the first one, if it's to earn rentals, investment property. They are held for to earn rentals or for capital appreciation. To earn rentals or for capital appreciation. Right? It is held to earn rentals. You rent it out, then it will be your investment property. For capital appreciation, also investment property. Meaning, investment property, they are not for own use. Not for owner occupied. If it's for own use, owner occupied property, they will be your PPE, IS 16. Is that right? So investment properties are those property which are held to earn rentals or for capital appreciation. So they are not for owner occupied, meaning it's not for own use. If it's for own use, like you use it as your factory, you use it for administrative purpose, then it is not investment property. They will be classified as property, plant, equipment, IS 16. Okay? And if the investment property is held for trading, held for sale, then it's not your investment property. They are inventory, isn't it? So it's not for owner occupied property and it's not held for trading. Not held for trading. Because if they are held for trading in the normal course of business, then they will be your inventory. Inventory IS 2. Okay. So when is it classified as your investment property? If it's not for own use, not for sale, then it is investment property. Meaning it's to earn rentals or for capital appreciation. Okay. So example, what are those type of investment properties? If you turn to page 94. So it's to earn rentals or for capital appreciation or for both. So investment properties are example like land held for long-term capital appreciation rather than short-term. Or even if the land held is currently a undetermined future use. Even I have a piece of land, I do not know what I'm going to use it for. I will classify as investment property, right? Because if I know that I'm going to use it as my office, then it will be my PPE, isn't it? Right? So even if I do not know what is it for, then it will be classified as investment property. Building lease out under operating lease, rent it out, they are investment property. Okay? So what is not investment property? If you look at the next page, types of non-investment properties. Owner-occupied properties. Remember, IS 16, PPE. Properties being constructed or developed on behalf of third parties. These are under construction contract. So they are also non-investment properties. Or properties under construction for future use as investment property. So currently they'll be accounted for as IS 16 until the construction work completed and then transferred to investment property. Okay, because if they're still under construction, then they will be my IS 16. Properties held for sale in the normal course of business, they are my inventory, IS 2. Can you see? So these are non-investment property. Okay, now, so investment property, also under non-current asset, PPE, investment property. When do we recognize the investment property in the books? So for all standards, after definition, recognition. When can we recognize investment property in the books? Now, investment property is also an asset. So when can we recognize asset in the books? Under the 2010 framework, the old framework that we are referring to, 2010. When do we recognize asset, liability, income, expenses? The first recognition criteria, like your PPE. When can I recognize the PPE? If I bought a building, I bought a machine, when can I recognize it in the books? The first recognition criteria is, what do we look at? Probable, isn't it? Right? Probable future economic benefits. Probable future economic benefits will flow to the entity. If it is probable that this investment property will generate future economic benefits, like your PPE, if the machine will help us to generate revenue, probable, more than 50% chance, okay, that it will generate future economic benefits. And second recognition criteria, assets, all same. If it has a cost that can be measured, it has a cost that can be measured reliably. It has a cost that can be measured reliably. Got it? Once it is probable that future economic benefits will flow to the entity and it has a cost that can be measured reliably, I will recognize as an investment property. But remember the revised 2018 framework? When do we recognize asset liability in the books? Do we look at the probability criteria? Do we look at whether is measurement reliable or not reliable? No. Under the revised framework, we will recognize if the information is relevant, faithfully represented, provide useful information to users, I will recognize. Isn't it? That is in the revised 2018 framework. Okay? But all these standards will still based on the 2010 framework. Understand? So this will still remain until when they revise all these standards. Understand? Right. So all the standards will still based on this recognition criteria. Okay? So once you satisfy these two conditions, you will recognize the investment property in the books. I will debit investment property. Alright? Same like debit, PPE. After recognition, what do we do? Always after recognition? Measurement. Yes. What is measurement? Measurement meaning assign a monetary value to your investment property. So what measurement do we normally have? We have initial, subsequent. Initial measurement, subsequent measurement. Initial meaning on initial recognition. First time when you recognize the investment property, it should be measured at what value? Always, even like PPE, initial, it should be at cost. Initial, always at cost. Subsequent meaning at each year end or at each reporting date. It should be measured at what value? If it's property, plant, equipment at year end, it should be measured at what value? PPE, remember we have how many models? 2. PPE, we can either use cost model or revaluation model. Is that right? Investment property, also we have 2 models, subsequent measurement. Cost model or fair value model, not revaluation model. At each year end reporting date, you can use cost model or fair value model. If I use cost model, meaning my investment property will be measured at what value? Cost model, it will be at carrying value. How to get carrying value? Cost minus accumulated depreciation. Is that right? Carrying value. Same like your PPE. If I use cost model, meaning my investment property will be measured at carrying value. How to get carrying value? Cost minus accumulated depreciation. Right? Okay. Fair value model. Fair value model meaning at each reporting date, my investment property will be measured at what value? Fair value. Will be measured at fair value. Now, what does it mean by fair value? Market value. So if you turn to page 96, fair value. Now, this is different from revaluation model. Okay, fair value model. Now, what is fair value? How to get the fair value? Now, fair value, we can either, fair value can be determined, if you turn to page 96, you can take the current price on an active market for similar properties, same location. So if I have this property, same type of property, same location, what is the market value? So that will be fair value. Or current prices on an active market for properties, you will not have the same type of property. Or we may have the same property but different location. So we need to adjust to reflect the value. Or we ask the independent professional valuer come and value my property. Fair value, isn't it? Right? Or you take the present value of the future cash flows. So all these are ways to determine my fair value, like my market value. Okay? Now, but what is the difference between fair value model and revaluation model? Now, PPE. If we use revaluation model, meaning our assets are revalued, isn't it? If it's revalued upwards, debit where, credit where? Debit, PPE. Credit, revaluation model. If the asset is revalued, increase. So debit, PPE, credit, revaluation reserve. If you go into revaluation reserve, meaning you will go into your OCI. Is that right? Okay, that is revaluation model. Fair value model. At each year end, the properties are valued at fair value. So let's say this year, the fair value is 500,000. Next year, the fair value 700,000. So meaning, is there an increase or decrease in fair value? Increase. So double entry, debit, investment property. Where do we credit? We don't credit revaluation reserve. Fair value model, any changes in the fair value recognized in the P&L. That is the difference between fair value model and revaluation model. So for fair value model, your investment property is at fair value. Changes in fair value recognized in P&L, not revaluation reserve. Revaluation model recognized in revaluation reserve. But changes in fair value model recognized in the P&L. So this is not the same as revaluation reserve. So this is not the same as revaluation reserve. Can you see? Revaluation model, yes. Any changes recognized in the revaluation reserve. But fair value model, changes, whether it's gain on investment or loss on investment property, recognized in the P&L. Understand? So that's the difference. Now, another difference is if we use fair value model for investment property, the properties are not depreciated. If you use fair value model, another difference is the properties are not depreciated. Revaluation model, the properties are depreciated, isn't it? Remember, even if I revalue, the assets are still depreciated. So fair value model is different. No depreciation. And changes in fair value recognized in the P&L, not in the revaluation reserve. You got it clear? If I use cost model, are the properties depreciated? Yes, carrying value, cost minus accumulated depreciation. Is that right? Now, generally, if it's investment property, which model do we use at each reporting date? We always use fair value model for investment property. Unless the fair value cannot be reliably measured, no fair value, then only we use cost model. Okay? Otherwise, all investment properties, they should be measured at fair value. Unless the fair value cannot be reliably measured, no choice, I have to use the cost model. Understand? So that is the difference between fair value model and revaluation model. Okay? Right, so remember, fair value model properties are not depreciated. Okay? Now, then the next area that we need to know under IS 40 is the transfer. Transfer from what type of properties to what type of properties. Let's say, currently this building is used as my head office. So, what are they classified as? If they are used as my head office, they will be classified as PPE, property, plant, equipment, because it's for own use. Now, I'm going to change from using it as my own factory, I'm going to rent it out. So meaning, is it investment, is it property, plant, equipment? No, it's no longer PPE. It's from PPE to investment property. Is that right? So how to account for the change? So there are three scenarios. Okay, so under this transfer, I don't have space, so let me bring it down here. So under IS 40, besides recognition, measurement, now another area that you need to know is how to account for if there is a transfer. Okay, there are three types of scenario. The first scenario is you transfer from investment property to PPE or inventory. The first transfer is from investment property to IS 2 or IS 16. First scenario. From investment property to inventory or PPE. Another scenario is transfer from inventory to IS 40. Inventory to investment property. IS 40. So how to account for all this? Okay. Another scenario is I transfer from IS 16 to IS 40. So there are three scenarios. One is from 40 to 16 or 2. One is from 2 to 40. Another one is 16 to 40. Okay. How to account for the transfer? Okay, so there are three scenarios. So if I am changing from investment property to inventory or carrying value. Now, if it's investment property, it will be at what value? Investment property always at what value? Fair value. Is that right? IS2 or IS16 will be at what value? Investment property is at fair value. IS2, IS16? So if I change from investment property to IS2, at the date of change, what value should I take? I should take the fair value of the investment property as my inventory or as my property, plant, equipment. Is that right? So if it's changing from investment property to inventory or PPE, what value should we take at the date of change? So we will based on fair value at the date of change. So we'll take the fair value to be the value of the inventory or property, plant, equipment at the date of change. Okay, so it's based on fair value. Because investment property, we always take fair value, isn't it? Fair value model. So at the date of change, use the fair value. But if let's say I'm changing from IS2 to investment property, these properties are held as trading, held for trading, buy and sell. So they are my stocks. But now I'm going to rent it out, this building. Then 2 to 40. So if it's IS2, what value? IS2, what value? Your stocks, what value it should be measured at? Lower of cost or NRV. So meaning is at, let's say, carrying value, isn't it? 40, fair value. So at the date of change, will there be a difference? Yes, inventory is carrying value. IS40 is fair value. So the difference between the two values will be recognized where? So difference between, if it's IS2, meaning is carrying value. So difference between carrying value and if it's IS40, it will be at fair value. Is that right? So difference between carrying value and fair value. Where do we recognize? Recognize in the P&L. If I'm changing from 2 to 40, page 96, investment property. If I'm changing from 2 to 40, if it's an inventory, it will be at carrying value. Investment property will be at fair value. So at the date of change, there will be differences, isn't it? So the difference between these two figures, where do we recognize? Recognize in the P&L. Okay, so all these are accounting treatment that I have to remember. What happens if these properties are used as my factory, my head office? Now I'm going to change it to rent it out. So 16 to 40. If it's 16, it will be at what value? Carrying value. If it's IS40, fair value. So will there a difference between carrying value and fair value? Yes, isn't it? So difference, what do we do? So for this 16 to 40, the first thing is difference between carrying value fair value. Difference between carrying value and fair value. Will be treated as revaluation surplus or revaluation deficit. Difference between carrying value and fair value will be treated as revaluation surplus or revaluation deficit. Meaning, same as in IAS 16, isn't it? Any changes goes to revaluation reserve. It can be either as revaluation surplus or revaluation deficit, whether the revaluation is increase or decrease, isn't it? Now, subsequent year. Okay. First time, the difference between carrying value and fair value recognized in the revaluation reserve. Treated as revaluation surplus or deficit, meaning it goes to where? Goes to your revaluation reserve. Right? Okay? Now, then, when it becomes investment property, at every year end, it should be measured at what value? Investment property always every year end at fair value. So next year, will there be changes in the fair value? Yes, every year end, it should be at fair value. So bound to have differences, isn't it? So then the next year, changes in fair value, recognized in the P&L, isn't it? So all this accounting treatment, I have to remember. First change goes to revaluation reserve. Subsequent years. Subsequent years, change in fair value, recognized where? Changes in fair value, recognized in P&L. Right? First change, recognized in the revaluation reserve. Subsequent changes, all recognized in the P&L because it's really at fair value. Fair value model, any changes goes to P&L. Got it? Now, let's look at one example. So that's IAS 40. I need to know the recognition criteria, measurement, and then the 3 scenarios on how to account for the transfer of the properties based on how you use the property. Got it? Now, if you turn to page 98, let's look at 98. Transfer. How to account for the transfer of the properties. Okay? From what use to what use. Now, if you turn to page 98. Now, example. Question asks, how will this appear in the financial statements as at December 09? When we say financial statement, meaning comprised of P&L, SOFP. What should be in the P&L? What should be in the SOFP? Is that right? When we say financial statement. Okay. A business owns a building which it has been using as a head office. So, what is it classified as? PPE, you've been using it as a head office. So, it is your property, plant equipment. In order to reduce costs, on 30th June 09, it moved its head office functions to one of its production center and is now letting out its head office. At first, I use it as head office, so PPE. Now, I'm going to rent out my head office. Meaning, what is it classified as now? Investment property, IAS 40. Just now, PPE, IAS 16. Okay? So, meaning, I'm changing from PPE to investment property. At what date? As at 30th June 09. And the company's policy is to use fair value model for investment property. So investment property, always remember, we always use fair value model. Unless the fair value is not reliably measured, then only I use cost model. Okay? Then the building had an original cost on 1st January 2000 for 250,000 and was being depreciated over 50 years. As at December 09, the fair value was judged to be 350,000. So how will this appear in the financial statement? So what should be in the P&L? What should be in the SOFP? Now, this is changing from 16 to 40. So 16 to 40, what do I need to calculate? If it's 16, I need to find what is the carrying value of the PPE. Then change to 40. 40, I need the fair value. So if there's a difference between the carrying value and the fair value, where do we recognize it? Remember, 16 to 40 changes the difference between carrying value and fair value. Where do we recognize? Recognize in the revaluation reserve, isn't it? Which is either revaluation surplus or revaluation deficit. Then subsequent year, if there are still changes in the fair value, where do we recognize? P&L. Is that right? Okay, so that's it. So now, what do I need to find? Since it's 16 to 40, I need to find what is the carrying value as at what date? I want the carrying value as at the date of change. When is the date of change? 30th June 09. So I need to calculate what is the carrying value as at 30th June 09. How to calculate carrying value? IS 16. Carrying value? Cost minus accumulated depreciation. Is that right? So what should be your carrying value?